You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 19th of February 2023, and I'm joined today by our special guest, Steve Daniels from the PlayingFTSE podcast. Steve, firstly, thank you very much for coming on the show. And if you're all right to just jump straight into it, could you just tell us a bit about yourself and how you got into investing and just a summary of your investing career to date?
Yeah, thanks for having me, mate. It's pleasure being here. Big listener on the show. We've listened to it for a couple of years. It's actually one of the reasons we started our podcast as well, is that we thought that you guys were giving great coverage of the UK markets, but you weren't covering as many US stocks at the time. We wanted to cover a bit more of the US and the EU and the UK, so that's why our podcast started. So a little bit of info for you there.
We've done the US at the end, and then occasionally we throw in an EU one. So like, for example, like Deutsche Post or something, if it's like a bigger German one or something, we occasionally throw it in. But yeah, we are sort of probably 80% UK focused.
Yeah, definitely. It's definitely where I go for my UK coverage, to be honest. You and City AM, I think, do pretty much all the stocks that I want to hear about. But a little bit about my past then. I don't think it's a particularly glamorous past. So I became interested in investing in the public markets just after the 2008 crash. And it was basically because me and my dad had been looking at the markets beforehand. We'd seen that the banks were like the darlings of the UK economy. They had a much higher share price than they do today. They were attracting stronger valuations too. And we just thought like these were never going to go bust. We were going to buy hatfuls of all the different UK banks and then just wait for it to return. Now that probably would have still made us decent money. Probably not the best investments you could have made, but yeah, I didn't actually do it. I chickened out. I went and bought some beaten up funds instead. My dad actually went and bought a Royal Sun and Alliance. Now I checked just before I came on the graph of this one, and he still checks the paper every day for this one, and he needn't do because it's moved 18% in about 20 years. So yeah, there's not much point in checking that one. It's not particularly exciting. So after this, I bought a load of private market stuff, and I've been really lucky in this market. So I was in a consortium of investors, sort of an investing club, if you like, that invested in an engineering firm, and that was expanding at the time. It doubled its branch numbers. It's actually since tripled its branch numbers, and it actually pays me a whopping dividend now. It's pretty much, we could retire today if it wasn't such a cyclical industry on the dividend alone, but we don't. We carry on working for now. So that money, I've used it for various things. I've had a portfolio of funds at Hargreaves and Lansdowne, which actually sold to buy a house. I rebuilt the portfolio in Nutmeg in, I think it was 2016. Moved over to Wealthify because I was going through sort of a phase of not exactly sure I wanted to manage my own sort of investments. But what made me start picking my own stuff was a book called Tim Hale's Smarter Investment, which, if you've read the book, hardly advocates for picking your own things, but it does highlight sort of just how useless the vast majority of fund managers are. And it's a bit of a crapshoot to buying these kind of things, because by the time they're already successful, and when you hear of them, it's often too late. So yeah, just carried on reading from there, carried on learning from there. I've done a full MIT course on valuation by Demoderan online, obviously. I've read all of his books. I've just kept it up, I guess. So recent history, did a bit of writing for Free Trade, did a little bit of writing for Substack. I'm too lazy for that. I haven't put pen to paper for a couple of years now. So nowadays I'm a public markets kind of guy. I still have some pre-IPO private market investments. I got in really early on Monzo, Patch Plants, that's just been acquired, VNext and ID Finance in Latin America, CarWow, which you've probably seen if you've ever looked at any kind of car videos on YouTube, Grind, decent sized London coffee chain, Chip, which is a little savings and investment app, Wise Alpha, which is great for buying corporate debt. And I actually invested in a company called Sono Motors, which has just listed on the NASDAQ, and it's doing absolutely awfully. So that's a little bit about my past.
So there's a couple of things you've mentioned there that I would like to dig into a little bit more. So you talked about the engineering company that you had. Is that a private investment, I'm assuming?
It is, yeah.
Okay. And then for the pre-IPO ones, how did you actually end up getting into those?
Most of them was through like Seeders and Crowdcube and things like that. I used to be part of a little investing club as well that used to take local private investments, like a credit club, I guess, is a sort of best explanation for it. But people would come pitch ideas, and the credit club would choose to invest in them or not. I haven't been to that in about 7 years, something like that. So, but I have moved out of Hull now. I actually live on the outskirts, so it's a bit more difficult for me to get there.
So were these private investments, were these EIS or anything, or is it just
Yeah,
is it more like crowdfunding?
Yeah, so well, you can get EIS on crowdfunding.
Right.
So yeah, a lot of these were through, like I said, things like Crowdcube, things like Seeders. So you can get all your EIS from it. You basically get a tax form once they meet the criteria. Some of them aren't, because things like banks, I believe, don't fall under EIS. So not all of them. You're always a bit sketchy around this kind of market because UK stuff likes to get acquired really quickly, from what I've seen. So if the bank if the investment gets acquired within the period that you need to hold for EIS, you then have to pay up. So it's okay. It does help with your tax situation. But yeah, that's where I found them.
This investing group you had, what was it, and how did you find it?
So it was actually my father who introduced me to it. He was he was a member. It was just a small consortium of people who were putting in money into stuff. Now, I was living at home at the time. I didn't go to university, not immediately anyway. So I was earning good money and not really having anywhere to put it. And he said, "Well, why don't you come along? See if you could put any of that money to work." And we bought together we bought a decent stake in this firm. And it was basically they wanted money to expand. They had one branch. They wanted to expand into another branch that was just slightly out the catchment area that where they were. They had a target in mind because a business had just failed in that area, and they wanted to basically take it over and take over all the assets. So we put a decent amount of money up for it, and yeah, it just all went on from there. It's happened again since actually they came back and said, we want to open a couple more branches. This was in a completely different area. That happened this must be about 10 years ago. I wish I had the dates. But yeah, it was about 10 years ago. They asked again if we wanted to go in again. We were already obviously major shareholders at this point. So we went again, and yeah, that's where we are today. Trying to be a little bit coy because I'm named on the register and it has my address and everything now. So
No, that's fine. So what are the main differences between investing in public companies versus private? And would you recommend people do allocate a portion of their portfolio to private investments versus public?
I don't think you need to. I think I've been exceptionally lucky. With private investments, you don't get as much data as you do from public companies, and you also don't get the sort of level of scrutiny that public companies have to go through. I mean, there's obviously still fraud in public markets, but I would expect that there's a lot more in private markets. There's also a lot more that they can say in their pitch decks and things like that they probably can't say if they're a public company. We're thinking about forward-looking statements and things like that here. So it's a bit kind of like SPACs. If you came across SPACs in the public market, they were allowed to say different things in their pitch decks because they were part of a merger and not part of an actual public listing. And it's kind of like that in the private markets. So I wouldn't recommend that people go into it. I don't think you actually need to. Like you say, EIS is a good benefit. You can use some of that to get a bit off your tax bill if you have a healthy tax bill coming in. But no, I wouldn't say you have to have any of your portfolio allocated to it.
I'm always quite wary with EIS and SEIS anyway. It's not something I've ever it's not something I've ever considered personally, but in my day job, I work in tax advisory and we have a lot of clients that do it. So we see it quite a lot. And what you tend to find is, I think most people with EIS and SEIS, you tend to get the tax tail wagging the investment dog. So you get a lot of people where they will basically invest just because they want to max out the tax breaks. And then if you actually look at the performance of these businesses, overall, most of them do lose money. And I guess that's the same in public markets with the majority of people anyway. But we do have very, very few clients that actually make good money on EIS. We did have Luke Hallard on a few months ago from Seven Investing, and he had some EIS investments, and he had one that had done very, very well. But then that was because he had a friend that knew the guy that was doing it, so he got in very early, and he actually he was able to get a bit more information than you typically would. But even then, I thought it was quite interesting, just in the same with public investing. The ones that I do know that actually tend to do okay, they are the ones that actually put the work in. They're not just going out and buying it because it's an EIS company and they like the sound of what it does. So like Luke Hallard, he will go to like roadshows and stuff, and he will go to shows where like they're pitching these companies, and he will go and filter through a lot before he actually invests in one. Whereas if you compare that to a typical client, they will just go to an IFA and just say, like, put me in 5 EIS companies or something like that. Yeah. And it tends to not work very well. The other thing I wanted to touch on was, you mentioned that you did an MIT valuation course. Could you just tell us a bit about what that was, why you ended up doing it, and what you got from it, if anything?
Well, Damodaran is the sort of king of valuation, so he calls himself the dean of valuation, doesn't he? So he puts his full MIT course, all of the lectures, on YouTube for you to consume, at your own pace, kind of thing. And you really do need to do it at your own pace sometimes, because he will bombard you with the figures. But you can just sit and do the whole thing. It's not a proper MIT. You don't get a certificate at the end of it, but you essentially do all of the work included when listen to all the lectures. So I did it because at the time he was putting valuations on Tesla that nobody else was putting on things. And I'm not a Tesla investor, but I just wondered why he could get so close and why other people couldn't get to the sort of figures that Tesla was trading at. And I basically did it to try and understand how he values a story. So rather than looking at the numbers, I mean, at the time, like everything money was really popular on YouTube. They were banging companies through this 7 checklist, and they were coming out and saying, okay, this stock that's trading at 300 is worth 10. And you thought to yourself, that just doesn't sound right. I mean, obviously we know that valuations have been quite high in the last few years, but how can it only be worth 10? And then Damodaran would come out and say, look, I can get to 200. And it really intrigued me what he was doing differently to other people. And it turned out that he was taking both the story and the numbers to generate a valuation, because he thinks the story is as important as the numbers. And it's an interesting take on things, whether when we go into this higher interest rate that we think we perhaps are going into, whether that will still be, the way to look at things or not. That's an interesting concept, something we could probably talk about. But it was a very interesting take. So I thought, this guy's got something to teach. Let's see what we can drag from him. And it's really interesting. At the end of it, he gives away all of his spreadsheet that he uses to work out all of his prices and everything. They're quite in depth. He's got 1,000 pages to one of his spreadsheets, but actually he only wants you to pluck 3 or 4 numbers out of the income statement to actually value something. So it's really interesting how it works. But yeah, you do have to sit through the lectures to get an understanding of why it works, I guess.
I've not actually heard of Damodaran before. Where can people go to find this if they did want to have a look?
If you just go onto YouTube and have a look at it's Aswath Damodaran, Aswath, and I've really put a rod for my own back here, haven't I? Damodaran. Yeah, he's a lecturer at MIT. He's got a lot of books out on valuation, the dark side of valuation. If you ever fancy a good read on valuation, is a very, very, very good book.
I'll pop it on my list, my ever-growing list.
Yeah, I've got the same problem. Yeah, ever-growing list.
How old are you, by the way?
I am 36 this year.
Could you tell us a bit about your portfolios then? We won't go into too much depth because we are going to talk about some of the individual stuff later, but in terms of the structure of your portfolio, because I know you've got 2. You've got like a fun one and then a more serious one, and just the logic for that and how that came about.
Yeah, sure. So on the podcast, I'm sort of known as the guy who will buy things at a slightly higher valuation than the other two. So Paul is into his dividend growth kind of stocks, and Steve's quite into his value stocks, whereas I'm the guy who'll always go just a little bit more fast and loose with a valuation. So what I found is that my main portfolio has an element of risk to it, but it's quite controlled. It's quite controlled risk. So I keep a risk score all the time. I have a set score that I'm trying to get at. I regularly rescore all of my companies just to make sure that they're falling within the sort of territory of risk that I want them to fall in. I have actually given away this risk score before on the show, so it's on episode 50, I think, or 51, if you want to learn how we think about risk. But the fun portfolio was mainly because I finished my ISA for the year. Couldn't put any more money in it. I'd put enough money into my SIP for what I wanted to put into it. So I decided I'd just stick a little bit into a fund company and have a go at picking the really, really sort of high growth speculative things. So I sort of meticulously went through and modeled them all. I think I started it about 18 months ago, but I'm not entirely sure about that. But I went through and I meticulously modeled everything in there, trying to figure out what companies could make a profit out of it, which ones could I actually visualize and model that could actually turn into a profit. And then I set myself a criteria of it being no more than 10 billion in valuation, so I'm getting a small cap growth. And yeah, just went through and I mean, I've started buying things quite early on. I think I bought 5 or 6 companies, and then I've really had to wait for some of the others because they were just so expensive, or I couldn't get to anywhere near the valuation that they were supposed to be at, or I couldn't get the I couldn't get the growth rates to work up to any kind of profit, or I couldn't see where they would, where the operating leverage would come in. Some of them I just couldn't even see where the flywheel was. But it makes a big difference when something's trading at 15 billion and it all of a sudden drops to 3 billion. You think, hang on a second, I can make some of this stuff work. But yeah, in my main portfolio, just to flick back, that's more controlled risk, looking at 10% returns from it, and not a lot else. Bit tech heavy at the moment, probably if you looked at it, but that's just where I see the returns at the moment.
Could you tell us a bit more about your risk score? I know you've got an episode that people can go to if they want to listen to it in full, but just in terms of a couple of the main things that you do consider when looking at the risk of a company and how you actually end up giving it a number.
So in terms of scoring something for risk, then I basically have like a points checker. So I really struggled with ETFs and funds when I started investing, when it told me the risk was 5 out of 7. I really struggled to sort of understand how risky or not risky that was. So I basically built this scorer, which I partially stole off David Gardner, but essentially it goes through various questions about the company's financials, the competition, the stock itself, the founders and the management, and then just a bunch of specialist questions. And it spits out a score at the end, which is more, it still gives you a score. It's still a score, I guess, but you can now sort of compare and contrast various stocks against each other to sort of have a better understanding of exactly where the risk lies in the companies. Rather than saying, oh, this one's a 5 and this one's a 5, you could say, okay, well, the risk in this one is that I don't trust the management, or the risk in this one is that the financials aren't as good as the other stock that I have. So we have given it away. It's in episode 51. I think if somebody wants to have a play with it, we also went through 4 stocks and scored them all as well. So it's one of those where it's just a yes and no exercise. So it's a load of yes and no questions. Every time you have a no, that's 0 points on me. That's a risky score. And every time you have a yes, that's not a risky score. So you end up with a point score at the end. Then you can obviously do that across your whole range of stocks, and you end up with a total risk score for your portfolio.
What do you do for work, by the way?
I'm an engineer. Yeah, so I do. I basically design roofs and floors for quite complex structures.
Right. What kind of engineering is that?
It's a civils type, but it's
right.
I'm known as it's specialised. So I'm known as a timber engineer. That's what I actually do for a job. But whenever you say that to any other engineers, they sort of roll their eyes and say there's no such thing. But that is what my official title is.
So could you talk a bit about the podcast and how that came into existence? I know you touched on it at the start, but also how your co-hosts and how it all came together.
Yeah, sure. So as I was getting back into investing, I was looking for that kind of investing club and sort of credit club again, somebody you could bounce ideas off. And I was sort of browsing around YouTube looking to see if there was any kind of little communities that had built off the back of it. And I stumbled across Paul's YouTube channel. Now, I thought Paul was a bit of a beck. And to be fair, I still think he's a bit of a beck, my co-host. But he did have a very, very good Discord community. And I'm sort of the good thing about a community is they act as kind of like a scouting network for you. So they can be stocks that you're interested in, but it's really tricky to follow. And you can have somebody in that group who's a specialist in that, and they just come back and they report the figures and they pull out the numbers that you want. And it saves you having to, pull up a piece of paper that reminds you what metrics that you're looking at for this specific company, or what the specific metrics they report actually mean. But anyway, we've been in this Discord, and Steve and I ended up being moderators on it, and we built up this and there's about 2,000 people in it now. It's absolutely crazy some days, especially when the legal and general dividend pops. Everybody goes mental. Yeah, so we just hung around in this Discord for a bit, and Steve and I used to have sparring matches in these sort of private messages, and then we ended up inviting Paul into it, and Paul was the details, the arguments you're having, the sort of points of view you're both putting across would be interesting to everybody. So Paul said, how about I be the ringmaster and you two just have a fight, and we'll put it out as a podcast. And it turns out that Steve and I agree on a lot more than we disagree on. In fact, we very rarely disagree on stuff nowadays. We did have a fourth member when we started, so hats off to anybody who's hearing this who remembers the original days. But Zach, he was basically going to be our guy who looked at all the crazy penny stock stuff. And he just disappeared one day, and we've never heard from him since. And that's truly, honestly, the story. We have no idea what happened to him. He just one day never turned up, and we've never seen him again since. So, yeah, that's the podcast.
So you didn't know them beforehand? You met them through the Discord group?
Yeah, met them through the Discord. Didn't know any of them beforehand. I still haven't actually met any of them in person. I've only chatted to them over because we live at opposite ends of the country. So Paul lives out Birmingham way somewhere, Steve's in Oxford and I'm up in Hull, so I think we're probably a good 3-hour drive away from each other no matter which way we go. So,
could meet in Birmingham.
Yeah, well, no, we're not going to Birmingham. No, I don't like Birmingham. We've got a fairly big client out there, and I had to make regular trips there when I first started. It's kind of like a rite of passage for people at our place to drive the 3-hour trip to Birmingham, and I'm not a big fan of Birmingham, can't lie to you.
So what are their backgrounds and ages then compared to yours?
So we're all of a similar age. So Steve's actually a philosophy lecturer at Oxford University. So he's a published author as well. I'm sure he won't mind me saying, although I don't know how many books he sold. He's very coy about that. Paul's actually a paramedic, or he was a paramedic. So he left last year and he does something else now, which I'm assuming is a private paramedic from what he's told us, but he's very, very coy about it because he's often in other countries providing this service. So I'm assuming it's something. It could be something military, I guess, but he's reluctant to say.
So could you talk to us a bit about your investment appraisal process? I know you've touched on the risk score already, but in terms of how you would actually approach looking at a new stock or potential investment and how it might even come onto your radar in the first place, and how much you do and how long it would typically be before you pulled the trigger and bought some.
Yeah, sure. So I do story first, and I've learned that from Demoder. And so I really want to know about the company, what it's doing, what it's spending on, where it's positioned, what its competitors are doing, what are the company's focuses at the moment. And then once I've got this kind of information, this story together, I run it through a second checklist that I've got. And I haven't released this yet to anybody because it's still kind of a work in progress, but it's basically a 100-point investing checklist. So the main headers are company financials, moat, its opportunities, its customers, its revenue quality, and its culture. And then I run it through, after I've given it scores for all of those points, I run it through a gauntlet of things I don't like customer concentration, debt position, either rapidly diluting, for example. And then after that, I then run my risk calculator on it as well. And then once I've got these two scores together, I can assign a premium to the company. So if I get through those scores and I get two fairly middling scores, a middling risk and a sort of a middling quality, then I'm probably not looking to go ahead with that investment, but I wouldn't apply a premium to it. So, for instance, something that I ran through that gets a middling score is something like Procter & Gamble. It gets a middling score for risk because it's not growing really any faster than inflation. It gets a middling score for its quality of company, again, because it's not really going anywhere. And then that would mean that I wouldn't apply a premium to that. So I would be looking to buy that company between a sort of 15 and 18 PE if we were using earnings as the multiple that we were judging it on. If, for instance, I run something like ASML through it, which I think has quite a low risk at the moment, and it also has a lot of quality. I mean, it ticks a lot of, I think it scores 88 out of 100 on my investing checklist, which I think the only higher score than that is Google, which I haven't run since ChatGPT came out, and I think it wouldn't affect the score at all. But so ASML, I can look at that company and I can say, look, I think this is a brilliant story. I think it's got fairly low risk. I think it's got a lot of quality. Therefore, I'm happy to buy this company at, maybe a 25 price to earnings or somewhere around that kind of thing. And this has worked out well for me now. It's still a working in progress kind of scoring method, but for me, it works really well for finding ways to buy really high quality companies, in the old Buffett mantra of pay up for quality.
So how long typically is it then? So would you say if stocks come on your radar, you've run it through this. If you like it, would you just then buy it, or would you keep it and watch it for a while and run it through again at a later date?
It depends really. So if it's something like an IPO where a company comes on and I think it scores really well on all of my metrics, I'll usually wait a couple of quarters just to see how it actually performs in the public markets. But if it's a really well-established company and it goes through my scoring criteria and my risk criteria and it comes through with flying marks, and then because I've already done the story and everything beforehand, so it took me about a day and a half to go through the story and the history. Then I will go because part of valuing the company is part of my checklist as well, so it's all included in that kind of process. And then after that, I'll do a formal valuation just using Demoda and spreadsheets, like I said, afterwards. Apply the premium that I have derived from my previous two checklists. And then, I could have a company researched and bought within 3 or 4 days if I'm dedicated, maybe a week. But it depends. Some companies I will score them, they'll score well, I'll value them, I can't get to the valuation, so I'll just stick a price target on it. And then when that price comes down somewhere near that target, I'll run them again to make sure that I still think the things that I thought before. Often it's difficult because, as you'll know, you've been investing a long time, is that sometimes when a price drops quite significantly, the mentality towards that stock also drops. And it's you've got to kind of fight yourself to get over that and think, hang on, why did I think this was really good quality before? Or why did I think the CEO was really, really competent and then he's gone and spent 30 billion on a messaging app or something like that? It's about kind of like constantly reassessing the process. But generally, if there's a company and I like it and it scores well and I can get it at the right valuation, I could probably have it bought by the end of the week.
What's the best book you've read on investing? And you can name more than one if you want. And how much do you read in general?
So I read a lot. I don't read as much as you. I thought I read an awful lot, but I think you put up nearly a book every week. Over the last couple of weeks, I've been noticing that you've been smashing me to bits on the reading. But I read 35 books last year on psychology and finance. That's a bit much for me, really, but it was nice weather, and I bought myself a hammock in the garden. So I read an awful lot. But my favorite book is The Psychology of Money by Morgan Housel, and I think Morgan just gets it, and he gets that not everybody's a textbook investor and that not everyone is going to do the optimum thing at optimum times, but he tells you that's okay. And he's quite contrarian in that regard. And there's a lot of things he's quite contrarian about. Like, he holds a lot more cash than standard investors because he thinks it helps him sleep at night, it helps him weather absolutely any shocks that come to him. So I think he's very hard to disagree with. But if you wanted a pure investing book, then I would probably go for, either of Howard Marks's books. I would probably say are my favorite books on investing, because he really sort of like drilled down for me about risk. He sort of really made me think about risk in a different way, and how I could basically put that into a spreadsheet, and how I could actually calculate it was, a key part of sort of Mark's teaching.
I've read so you probably read more finance books than me, because a lot of my reading's quite broad anyway. I certainly didn't read 35 investing and psychology books last year. In terms of the books you've mentioned, so Psychology of Money I've read, and that is excellent. I think it's a very good book to start with as well, if you were just starting out. Howard Marks, I've read The Most Important Thing. I wasn't aware he had another book. What is his other one?
It's Mastering the Market Cycle. So as you can see, the most important thing is, it's quite an interesting book, really, isn't it? Because you think you're going to find out what the most important thing is, but he basically tells you the most important thing is everything.
Yeah, it gives you about 10, yeah.
Yeah, and that's the same thing with Mastering the Market Cycle. You don't actually find out how to master the market cycle, but he gives you a lot of information onto how it all works. But I guess I could tack another one on there if you want a third one.
Yeah, go on.
Book by somebody called Annie Duke, and she's on the sort of investing talking circuit in America, talking heads kind of thing, but she's actually a professional poker player. And she has 2 books out at the moment. One of them I wasn't a massive fan of, but the second one I really was. The book's called Quit, and it talks about when it's best to walk away from something, even early on. And she talks about Stuart Butterfield, who is was the CEO of Slack before it was acquired by Salesforce, and he's since left the company. But basically, he was the CEO of a game development company, and they developed this quite niche game and released it out to the market with quite a bit of private equity funding. It'd gone out to a sort of a mild success. It had a player base that was playing regularly, daily, weekly, but it wasn't a massive hit. And he had basically told the private equity that this will be a slow burner kind of game. It'll be people playing, getting addicted, inviting their friends. Eventually, the player base will grow. And then one day he came in and said, "I'm shutting the game down." And this was still really early after releasing it. And they were saying, "Well, what do you mean you're shutting the game down? We've spent, tens of millions of pounds helping you get this out. You've only really just released it. You said it was going to be a slow burner." And he said, "Look, I went home and I thought about it a lot, and I thought this game's never going to make it. It's never going to be big enough to return your money. So what I want to do is shut the game down." But we've been using this text-based communication system within the team, and we think it's great. We want to shut down the game and we want to focus on this text-based communication system. So luckily for him, they backed him on it. This was the beginnings of Slack, and he sold it to Salesforce a couple of years ago for about 30 billion, made them a hell of a lot of money. So Hairbook is basically all about that story and the broader story of quitting early when it's right to quit. And it's a pretty interesting book.
I've heard that story before, and I have heard of the book, but I've not read it. So I will definitely pop that one on my list. Actually, do you listen to Howard Marks's podcast?
I don't know. No,
it's very, very good. If you liked his books, I would recommend it. So what it does is it's got like his historical memos, and they've just been narrated. But then after each time he releases a new memo, it basically goes like, it's an interview about the memo and like what's the thought that's gone into it and stuff. It's not loads, because it's only whenever a new memo comes out. So it wouldn't take long to clear the backlog either, but it's very, very good. If you do like Howard Marks, I would recommend it. Yeah,
I mean, I really like listening to him talk. So I guess is it actually him who talks about it?
Yeah, it's him narrating it, I think. So yeah, it's on all like the normal podcast apps. If you just search Howard Marks the memo, it should come up at the top.
He's a very cool character, isn't he? He's permanently unflustered.
I do really like him. As you go through it, so I started with the oldest ones and just worked through the backlog. You can listen to his strategy evolving. Like there's some of the stuff he says a couple of years ago, we're actually saying, well, I was wrong on that. So like one of the stuff he was saying like a few years ago was, if you're doing well on a stock and you take profit on 50% of it, you can only be half wrong. And then he's actually come back now and said, well, actually, I disagree with that. I think you should either, like, that's not always the correct advice. And sometimes you can be wrong, even if you're selling half. So it is interesting how he's got that accountability on the podcast as well. And you just change it in real time as he's learning. And what's interesting as well is that he's obviously like 70 years old and he's been there and done it all, and he is still learning.
Have you read Soul in the Game by Vitaly Katznelson?
No, I've not heard of that one.
That's well, do you know the series of books that are called the Little Book of?
I do, yeah.
So he wrote the Little Book of Sideways Markets, which is a really, really good book. But this So in the Game is kind of an amalgamation of everything he's learned so far up to the point, all the times he was right and wrong. And basically it's a book about, because he's from Murmansk in Russia, and his father was I think he's a communist sort of army cadet trainer or something along those kind of lines. And it's a story about how he came to America and he didn't know anything about America or anything about the language, how he learned to speak. And we're talking about he was about 16 or 17 when he came over, but how he went from being a 16, 17-year-old guy from, communist Russia. His father worked for the Communist Party essentially, and how he became a portfolio manager. And it's all sort of he's got tidbits of his life and about his kids growing up, and quite a bit about classical music, strangely. But it's a really good read. It's a real jumble, because he said, like, I want this to be in the lessons I learned that I think are the most important. So at some point you read in the book and his children are like 6, and then he goes to the next section and his children are 18, and then the next chapter his children are back being like 10 or something like that. So it's kind of like, it's a bit of a like, you're in the time machine going back and forward to get it. But it's a really good read. There's times when you get in the book, and I read it in 2 days in the hammock, and it's a fairly big book, but he does go over everything that he's learned, and it's a really interesting book.
I'll pop that one on the list as well. What are the best resources you use for investing? And these can be free or paid.
So I don't actually pay for anything. So Paul has a Morningstar and a Fastgraph subscription, and he was kind enough to give me the logins for them. So I do have a look on Morningstar, and I do have a look on Fastgraphs from time to time. Fastgraphs is really good for plotting different types of company earnings against their valuation. I don't know if you've ever used the tool before, but so we would use it for something like Amazon, which we think Amazon's a really difficult company to value because they suppress so much of their earnings by spending it on other things. The other thing that we have a slight issue with is that they have to keep writing down the Rivian stake, which is, I think it was about 11 point something billion at last time I checked it. But obviously that's not actually a company loss, if you know what I mean. So whether you should subtract that from there, if you were doing a PE based valuation on Amazon, it's almost impossible because of all the things you've got to try and sort of feed back in. So what we did with something like Amazon is we would value it on its operating cash flow. And the best way to get sort of a historical valuation of Amazon based on its operating cash flow is to bang all that into fast graphs, and it'll plot it against its evaluation. So valuation, operating cash flow, you can see how tightly Amazon has tracked that line. And I'll tell you off the bat, it's like neck and neck all the way along. And the reason being for that is because that's what Bezos told you to do in all of his letters. He said, don't value Amazon on its PE, value it on its earnings, value it on its operating cash flow, because that shows you, what cash the company is producing. So that's what we would use FastQuest for. Simply Wall Street's free tier. I do like that for just a really sort of like whistle stop overview of a company. It gives you sort of like, it's all in images. It's really easy to understand. It's a whistle stop tour, top to bottom. Quite interesting, really, just to quickly get an overview of a company. I use Quarter for earnings calls. That's QUARTR. You can plug in all of the companies you're interested in onto there, and every time there's an earnings call, they'll just send you a notification. You can go on, you can listen to the earnings call. You can skip to the Q&A if it's only that bit you want to listen to. You can speed through it at a faster rate if you think they're talking too slow. And my new favorite tool is called ROIC.ai, which is actually one I might pay for. I might buck the trend with this one. But this gives you about 30 years of historical financial data for companies. It's free. You can plug in, at the moment, you can only plug in American companies for the free tier. You have to pay for the European and the UK. So I don't know how good the data is for that, but it's an exceptional tool for looking at historical financials and seeing things grow and trying to plot sort of growth paths for companies.
Who do you look up to as an investor?
So, I mean, we could probably skip the obvious ones, because I think we've spoken about how much we sort of admire Marx, and I mean, I'm going to put Buffett and Munger on the list of people I admire, and Lynch as well, Peter Lynch. But I think if I was going to go less obvious, I'd go with Josh Tarasoff from Greenlee Capital. Do you know him?
No, I don't.
So back in 2011, Josh wrote a thesis on Amazon, and he shared it online. And at the time, I think Amazon was trading at about 180 times earnings, and it already had about 48 billion in sales, which at the time everybody was saying it topped out. Amazon wasn't going to get any bigger. But Josh basically wrote out this whole path for Amazon. He said that it was going to be this massive company. I mean, he nailed everything. He nailed the uptake of AWS. He nailed the growing arm of Amazon's marketing. He sort of nailed the virtuous cycle that is e-commerce adoption. He called it the finest business he could find, and he was right at the time. So when he actually came to selling that position down, he was about a 16x. So what I admire about Josh in particular is that he took a really contrarian position, but he actually took the time to spell out exactly why he was taking that contrarian position, and then absolutely nailed it.
Which Twitter accounts do you recommend following the most? And you can give yourself a little plug here.
So to be fair, I don't really recommend following myself, because most of the time I'm just saying like, this company did well, that company did well. I'm not really up there for plug in like really big analysis on Twitter. I think it's a pain in the ass to write on, but there are a few people I would recommend following. So if you're into your American companies, Consensus Gurus is a really good follow on Twitter, especially around earnings time. They've got this checklist of stuff that they check for companies, and they post up basically all of their earnings, all of their reported metrics versus consensus. So you get a really good idea of how they got on, and then they just run a list on the side that says, hit, miss, hit, miss, hit, miss, miss, miss. So you can see how, just at a glance, really, how this could be perceived. So if we were going for a funny one, outside of Parik Patel, which I'm sure most people know about, I would go for Cubico. That's Keubiko. So he's quite abrasive, but he spends a lot of his time doing what he calls educating baggies, which is his speak for sort of correcting people who've lost money on their investments, who are blaming nefarious things like naked short selling and dark pools and things like that. So what you will learn from him is a lot about the options side of the market, and intersperse that with memes of people with mashed potato for brains. It's a really interesting follow.
What do you know now that you wish you knew when you started investing?
The big one for me is that I think short reports are mostly rubbish. So I got shook out of a public investment by cover to cover reading a short report and thinking that their quality of information trumped mine. So two spring to mind for me. So Albemarle was one that I sold. I was about 30% up on it, but it's since 4x'd. And Enphase is the other, which I sold just, I think it was about 10 or 12% down, but it's now been a 6 or 7x. The Enphase report was really damaging for me, and it sort of insinuated that they were fabricating a large proportion of their revenue. And they've actually since been accused of this again about 2 or 3 years ago. But I think I've got a bit of shame in not holding that stock until now, but at the time, I think that the evidence for it felt like it was quite overwhelming. So that's something that I would sort of listen to now, is that most of these short reports are sort of like sensationalism, and I would try to avoid them.
How have you evolved as an investor?
I don't know if I have evolved. I think evolved is a strange word. I think investing is quite iterative. So you get a little bit better of it over a long period of time. So you can learn the rules of the game through sort of playing at it, and you can get better at sticking at stuff. But one of my key sort of learnings is that risk isn't linear. So you often hear phrases like high risk and high return, but in investing that doesn't work. Like high risk often means no return. So I think, again, it's just about learning all the time, and it is like, you've got to understand it's going to be a really sort of iterative process, and sort of I always think evolution is a big change, and I'm not sure that's necessarily the truth.
What are the biggest mistakes you made as an investor, apart from reading short reports?
Yeah, well, I guess Enphase and Albemarle are pretty big errors when you think about how well they've done, but I've got a fun one for you. So I really like ASML. It's one of my biggest holdings. I did a deep dive into the component suppliers for ASML, and I came across Carl Zeiss, and it's the only company in the world that can make the super flat mirrors that ASML needs for its EUV machines. And these mirrors are so flat that if we blew them up so they were the size of the Earth, you still wouldn't be able to see any of the kind of imperfections in the mirror. So I thought, hell, this is a good quality business. I know of Carl Zeiss from my lenses back when I used to do a bit of photography, and went through the business. I was thoroughly impressed with the business. It passed all of my checks. It got a premium, and by the end of the week, I'd bought stock. What I didn't realize at the time was that my broker had truncated the name, and I wasn't buying Carl Zeiss. I was buying Carl Zeiss Meditech, and they make microscopes. So yeah, it was basically a spin-off of the major brand. I actually got away with this one because it was in 2020, and anything you bought went up. I sold it for about 20% gain. But lesson learned now was to actually check the ticker against the actual full name and figure out if I was even buying the right company.
Well, you're not doing too bad if your biggest mistake was a 20% gain.
Well, because I'd already spoke of Albemarle and Enphase.
Yeah.
Yeah.
What are your thoughts on current valuations in the US?
So look, I think the US is priced at the moment like it thinks the interest rates are going to go straight back down to zero or near enough zero. So if that happens, I think things look pretty much okay. But if it doesn't, stocks will look really expensive. I mean, broad brush valuations, I don't really care that much about because I don't buy anything as broad as the whole US index. So generally speaking, I'm not really struggling to find things to buy, which is a bit of a Kramerism, isn't it? There's always a bull market somewhere. But I think I'm not particularly bothered about US valuations at the moment. I think that will just play out on its own. It's up to me to sort of navigate that situation.
Would your opinion have been different if I'd asked you that 2 years ago?
Potentially.
I know hindsight massively will impact the answer, but
yeah, potentially. I mean, it's really difficult not to get wrapped up in the sort of hysteria, isn't it? I think I had a bit of fun money and placed it on the Lucid SPAC, and I think I saved 6 or 7x my money on that. And it was really difficult at that period to say, like, hang on a second, this is getting really, really stupid. I think there's a famous Buffett quote about people staying at the party with a clock with no hands, and at times a couple of years ago it did really feel like that. But yeah, I think I got away with it fairly scot-free. I think I was one of the lucky ones who didn't buy into it too much. Well, nobody on our podcast bought into it too much. I mean, Paul and Steve don't buy that kind of company, and I chose to create a fund portfolio just because those valuations had completely blown off. They actually started blowing off about 9 months before the market did as a whole. So by the time I was buying into these companies, some of them were already down, in half, but they did obviously continue going down the year after.
What do you think of valuations in the UK at the moment?
I think as a whole it's cheap, but it's cheap because it's a cyclical market. So you're experiencing sort of top cyclicality sort of price. So the UK has just kind of gone through a period where sort of heady profits have meant low valuations. And I think that will correct a little bit as we go out of cycle. But I think the UK market has some great stocks in it. I often struggle to see and plot the growth over a long period of time, but cheap metrics will look cheap to everybody. The UK at the moment, I see very little growth or reversing growth. So if that happens, then obviously nothing is too cheap. But there's lots of opportunity in the UK market still.
Do you find that in your own investing, you're still finding the US more attractive then than the UK?
Yeah, I think it's about sort of fishing where the fish are. I think that's a Munger saying, isn't it? And that's kind of what I think about the US. There's a large populace of people over in America who have quite a lot of disposable income. Plus, the US companies tend to be fairly global as well. So they're very good at getting stuff onto other shores. So for me, that's why I tend to look at the US. I think I've not actually weighted it recently, but I would say a large proportion of my companies are US based because fish where the fish are.
How do you think about allocation and position sizing in your investments?
It's one of the things I'm still working on. So I wish I was a bit better at it. I basically set my rules on allocation based on how the businesses score in my checklist, and then quite often break those rules. I try not to go over 10% allocated to a stock over a prolonged period of time.
Is that on a cost or a valuation basis?
That's just a total basis, a total
Okay.
valuation basis. So if something's down 20%, I will continue buying up to that 10% mark. But yeah, I really don't want to do that unless I think it's a really fantastic opportunity. So there are things like Amazon at the moment and Google, which I have pushed really hard on over the last year. I've taken them from 6% up to 10% of my portfolio each. So they're quite heavily weighted to those companies. I think they're pretty good opportunities at the moment.
Where's the 10% upper limit come from?
It doesn't come from anywhere in particular. It's just a kind of a hard stop where I thought, hey, if I lose 10% of my portfolio here and that disappears overnight, how would I feel? And how would I be able to sleep at night? And sort of also having to go and tell my wife as well that I've lost 10% of the portfolio. So that's my kind of hard stop before I would probably start to struggle with it. I mean, I know there's people who will go up to sort of 60% on a stock, or some people just have one stock. And to me, that's absolutely bonkers. I just think I don't trust any of my processes enough to put 100% of my portfolio in a single stock. I mean, I know the Tesla guys did really, really well out of that a couple of years ago, but I definitely wouldn't trust that process going forward.
How much time do you spend a month on investing in your portfolio? And this will be excluding the podcast.
So too much is probably my answer to that, because I think I say excluding the podcast is difficult because we're always sort of fielding questions about our investments. So every week, Paul and Steve like to give an update on what they've been doing and how their portfolio has done. So it does make you look a lot more than you should. And I think it's a really bad habit. Last year was quite intoxicating for me. I had a pretty decent pile of cash all year, and everything just kept getting cheaper. And I was sitting and waiting for the sort of prices I wanted, and price targets would ping off. And I kept sneaking the occasional kind of like, "Ooh, how close are we to being able to buy this?" I think it was a bad year for spending time looking at portfolio and investing, and it's probably one of the things I would say I need to improve on.
Is that cash position still there, or has that now been utilised?
It's gone now. It's completely gone. I had my last £32 was just sat in my account. I didn't even know it was there, and I bought 10 shares of NatWest with it or something like that, just to finish off the rest of the cash. I don't have a penny in cash and no ISA limit left until it resets in April.
What are your thoughts on Bitcoin as an investment?
Generally, I've got no interest in it. I tried to be interested in it. I don't really thoroughly understand it. I don't really understand its use cases. I think we've been quite a long time now, and we don't really have a single use case for any of the kind of cryptocurrencies and Bitcoin and Ethereum. And I have a little bit of Ethereum, I have a little bit of Polkadot, but I don't look at them. I don't know what they're trading at. I don't believe in their ideals. If you want a thorough sort of like take on my opinion, there's a YouTuber called James Jani, Jani, that has done an excellent sort of YouTube video on crypto. And that video is generally how I feel. I think the title of the video is something like "Crypto is a Scam." And I think that's kind of where I am.
Have you ever read any books about it?
No, I didn't realize there were many.
No, it's just one thing. Like I would put Bitcoin in its own category, which is why the question was Bitcoin. I wouldn't say I'm particularly interested in the rest of crypto. Some of it might work, but I think there's a lot of bad actors, and it's like trying to pick the winners. Yeah. And even then, like there was a guy at work chatting to me about it because he knew I had some Bitcoin a couple of weeks ago when we were out for a few drinks after work, and he was telling me about this cryptocurrency he'd bought, and I was asking him a few fairly basic questions about it, and he could tell you the story of it and what it was going to do and how amazing it was going to be, and then when you started asking him a bit more questions, he couldn't really answer it. And then I just said to him, well, all right, if you are actually right and this crypto does do what you think it's going to do, why does that make the token valuable? Why can't the token just stay at the current price and it still work? Like where does the value flow into the token, and why is that other than people just buying it at a higher price than you? And again, he couldn't really answer that, but I without going into it loads, I do think with Bitcoin, I do think that is different to the rest. So I would recommend reading about it, because it is, at the very least, it's very, very interesting, just like the history of it and how it came about. But yeah.
Have you listened to the Rational Reminder podcast?
I haven't, no.
That's a really good podcast by a guy called Ben Felix. He's basically an ETF investor. He's one of those really good sort of describers of ETFs, and he looks at sort of value factor. He's really, really well researched. Him and his co-host went for, I think it was a 10-part series where they invited all of the sort of like really sort of loud voices in crypto, both the bulls and the bears, to come onto the show for, I think it was 10 hours. I think they came on, maybe a bit longer than that, and just talk to them about crypto. They would ask them, because they didn't know really anything, they would just ask them general questions about it. And I've listened to all 10 of those episodes, and I came out of it with a probably a more negative opinion than I went in. And
is this crypto or Bitcoin now?
It's both.
See that I think that does it a disservice. Though I think that would be like talking about. I'm not saying they're the same, but I think it like a sort of a good comparison for me would be, it'd be kind of like if you were not into investing at all, and I was trying to plug Berkshire Hathaway to you as an investment, and you did a 10-hour thing, and you got me on, and then you got 9 people that were shilling SPACs. You're going to come away with a very negative view of the stock market. It doesn't. But obviously it's completely unfair to compare Berkshire Hathaway to these SPACs. And I think that is what happens with Bitcoin a lot. I would say if you are interested in learning more about it, and in fairness, if you've already listened to 10 hours, your answer might just be, well, I'm not. But there's a guy called Peter McCormack, and he's very, very, so he's a guy from, he's from Bedford. And he actually recently bought the football team there with like the money he's made in Bitcoin, and he's called it like Real Bedford, and he's started like doing loads of funny stuff with it. He's a really interesting guy, but he's got a podcast called What Bitcoin Did. And if the podcast is it is all right. Well, it's pretty good, but it's like every week it'll be like a 2-3 hour interview about Bitcoin, which you don't really need to listen to, I think. But like on his website, he's got a little like where to start for Bitcoin. And it'll be a step-by-step of resources to look at. And he is just focused on Bitcoin. And I would think that if you were to do something like that, it's going to point you in the direction of the right resources. Because the problem is there's just so much information. It's so easy to just end up like, well, you end up learning about crypto as a whole, and you come away thinking, well, most of this is a scam, and Bitcoin sort of gets lumped in with that. But I think really for me, and even John to an extent, because John was very skeptical, and then in the last sort of year or two, he started buying a small amount of Bitcoin. But I think the main benefit, and we're seeing that now with inflation, is it is a hedge against the financial system. It's a way of opting out of inflation. I appreciate it's very, very volatile. So you can say, well, you save yourself 10% inflation, but you're down 80%. But it's more about an alternative money supply that can't be manipulated. And it's more of a store of value. I don't really see a scenario where everyone's going and buying the Starbucks with Bitcoin. It's just not, it's not going to happen. Whereas I do see a scenario where people are like keeping significant portions of their savings in Bitcoin because it can't be manipulated. I think that becomes more and more attractive as we get more and more money printed. But anyway.
I knew we were in serious trouble in the crypto market though when I had a painter and decorator in, and he was talking to me about, I think it was Chainlink. He was talking to me about, and he was saying, "Yeah, I don't really know anything about it, but I've bought some Chainlink," and I thought, God, this market's in trouble.
Yeah, well, I can't remember what was it. I was in a bar with some friends. This is like 18 months ago, and we were talking about something, and the bartender overheard. He just started plugging it wasn't crypto, but he started plugging all the metaverse stocks and stuff, or it might have been some of the metaverse cryptos as well. But it was just, and again, it's like when your bartender's overhearing and just telling you like what to buy, and like
shoe shine boy.
It is a sign of but you get that in everything. You get that in stocks too.
Yeah, absolutely. Yeah.
It is particularly bad in crypto. I'm not going to lie. But I would differentiate Bitcoin from the rest of crypto. Anyway, that is the end of the questions about your general philosophy. The next part is questions about your specific portfolio. What I'd propose is, I think we've got enough for one episode, and we can then do this as a separate episode. So thank you very much for coming on the show. Where can people go to find out more about you if they want to?
Yeah, so if you want to find out more about us, the best place to do it is just to head over to our podcast. Really, all of our links from that point onwards are always in the description. So the podcast is called Playing FTSE. That's as in FTSE, not FOOTSIE. We're a weekly show released on Sundays. We also have a highlights channel on YouTube where if you haven't got time for hour-long content, you can do it in little 10-minute segments. But yeah, that's where you can find us.
Right. Well, thank you very much for coming on the show, and we're going to do the second part of the interview as a separate episode where we talk about your specific portfolio. So if anyone has enjoyed listening to this, then do check out the next episode as well, which will be basically a continuation of this interview. Right. So thank you very much, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.